when it comes to the markets, what sort of reaction are we expecting from Asian equities, given that we didn't get that sort of major stimulus that we were expecting?
Yeah, so yesterday obviously was a very significant pullback, but I think we have to remember that that came in the context of the market being up 38% from the low on September 11th. So we had a huge run and a lot of expectation built up about easing. And in conversations with with investors over the past few days in the run-up to the NDRC meeting yesterday, there were some overly inflated expectations about, first of all, what might be announced and then the magnitude of what might be announced. So what was indicated in various press rumors in the media around the time that Xi Jinping and then Li Cheng were making announcements on fiscal was about, call it 2 to 3 trillion renminbi of stimulus. Expectations then inflated to up to 10 trillion, which was wildly overly optimistic. And so I think there were a number of, you might call them tourist investors, who were unaware that the NDRC meeting was never one that was going to have those sorts of announcements.
We do have the finance ministry meeting coming up.
We need to see the Ministry of Finance, which is where fiscal stuff would be announced, number one. And number two, it's the National People's Congress Standing Committee meeting end of this month or early in November, which will be when the official ratification of such policies would be announced. So those are the really two key events we need to look forward to. So I think what's happened is that the market was overly optimistic, overly inflated, momentum indicators super hot, and we had an outsized correction, but I think it's within the context of what should be expected.
And within the context of you expecting up to 20% increased returns.
Yeah, so to put some quick numbers on it, so we think that what's happened in terms of the announcement on policy support effectively takes out some of the downside risk to growth, and the market was pricing a lot of that. So to give the numbers, on September 11th, the Chinese offshore market was trading at 8.4 times forward price earnings ratio, very, very low. We think it's worth about 12. In the course of the rally, it got up to just shy of 11, and now we're back down to 10.8 as of last night's close. So we still have some, call it 1.5 multiple points we could expand, and as we go through time, some earnings growth, and you put those two things together, you get 15 to 20% without stretching the imagination.
Tim, do you characterize this as a tactical rebound or more of a strategic, fundamental shifting in the way that we look at China? Is it too early to be able to make that call?
So, Heidi, that's a great question. That's really the top-of-mind question that many investors have been asking us, so thank you for asking it as well. The simple answer is that there's just not enough information to make a call that this is a structural bull market, because that would effectively require assuming that all the many macro challenges that China faces, which are well known in terms of demographics and debt and property market and domestic policies as well as geopolitical risks, that all those magically have gone away with a few policy announcements by the central bank and by President Xi and so forth. So there needs to be more substantive evidence of what actually is being done to structurally address some of those challenges. So I just don't think we have enough information to make that call. But the key thing we would say, if I could, is that if we look, say, for example, at the Japanese market history over 30 years, there was fundamental bearish conditions, but you had 7 rallies of 50 to 140% lasting 2 quarters to 2 years. So very tradable moves, even within a very negative fundamental environment. I'm not saying it's a perfect analog, but it's interesting historical evidence that even in a challenged environment, you can have moves that could be very consequential for investors.
So we had a great chat up before looking at the CSI 300 momentum near the highest ever, right? Maybe we can get that back up again. I think that sort of goes to what you were talking about a little bit earlier. At this point, still riding the sort of tactical aspect of what we're seeing. How do you play China at this point? Where do you see kind of the biggest opportunities, given that we have had this run up now?
So there are a number of areas. I'd say the one we just flagged in a report we put out yesterday would be the small and mid-cap China A shares. So the quick logic there is, number one, the market was closed for a week and only just reopened yesterday, but actually the people who just opened up new accounts, they can't trade until today. And in fact, we saw some hedge fund shifting from H shares to A shares yesterday in the record turnover volume in Hong Kong in order to get ahead of that theme. So when retail investors come back, typically they go for the smaller and mid caps. That's the clear characteristic of the Chinese A share market. So, for the higher octane part of the investment spectrum, I think that's the area to look at, the smaller and mid caps in the A shares.